whip through Chapter 4. Chapter 4 is about income, really. You know, we've kind of talked about some big picture stuff. And Chapter 4 is going to get at what kinds of things constitute gross income, or items of income that are taxable. You can see in Chapter 5 and 6, we're going to talk about deductions and then some loss issues there. So I'm going to kind of just breeze through this chapter, point out some things, and refer to other things for you to read on your own, and we'll just kind of see how it goes. As always, ask questions via email or preferably in the discussion board posts in D2L. The chapter starts off with as always, there's a like a little context that they give you. The chapter starts by talking about the tax formula, how taxes are computed, and this we'll get into a little bit later in the text too. But we start talking about components of the tax formula with income. The idea that income is defined as, it's a very broadly conceived idea that really anything you get that has value is included in this idea of income, but a lot of things are excluded from income specifically. So once you exclude those items, you end up with this notion of gross income, which is income items that are taxable and that have to go on a tax return. Some examples down there. In getting to the tax calculation, you get to subtract from gross income anything that would be classified as a proper deduction, which will be the concept in next chapter. And then once you subtract deductions, you arrive at this term called taxable income, and we calculate our tax liability based on that number. We just apply tax rates. So that's kind of a big picture here. What is gross income? This, again, it's like I said, it's items of income that are taxable. And you start off with this idea that you're talking about anything is income if it is increases your wealth, but not everything is taxable. Some things are excluded. So plenty of things give you economic income, but aren't in fact taxable, and we'll see some examples of that in the chapter as we move through. Lots of like little vignettes, as I'm sure you've seen in the chapters now, little highlights, little stories are not part of the text verbiage, but interesting little anecdotes. So I encourage you to read some of those. Brief little discussion here about comparison of accounting and tax concepts of income. We saw in Chapter 3 there's lots of differences between the accounting rules and the tax rules, so different treatments for the same item under each set of rules. And one of the judges in a decision kind of discussed the different goals of both the accounting information rules and the tax rules. Discussion on form of receipt. So you can have income that is taxable even if it's not cash. Anytime you get value, you potentially have something that's taxable. 4.3 talks about year of inclusion. So this is a big issue. It gets at really the idea that income is taxable to you, typically depending on how what method of accounting you use, whether it's the cash method of accounting or the accrual method of accounting. So this learning objective 2 discusses that. Cash receipts method, simply you record taxable revenue or gross income when you receive cash. You record deductions or put deductions on your tax return when you pay cash. There are some examples right here. Keep going. Under the accrual method of accounting, this is not new to us. We know that the accrual method is you record revenue, recognize revenue when you earn it, regardless of when the cash is collected. You record expenses when they're incurred, regardless of when the cash payments are made. There's also hybrid methods for companies that do different kinds of businesses that lend themselves to different methods of accounting. So we'll start the next video with some special rules.